Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. I want you to imagine for a second that you could hire, I don't know, 1,000 highly capable interns for your business.
Right, just a massive
Yeah,
workforce.
exactly. But here's the catch: your total payroll for the entire day for all of them is just 14 cents.
Yeah, 14 cents. It's pretty wild to even think about.
It is. And that is exactly the dynamic that is unfolding right now, like literally right now, as of August 2026, in the global artificial intelligence market,
Sure.
specifically over in China.
Right.
And if you're sitting here wondering, why should an American investor or just a regular consumer even care about some overseas AI market? Well, you have to look at the broader landscape. I mean, especially right now under the current Trump administration.
Oh, absolutely. There's so much focus on geopolitical trade, tariffs, and really protecting American technological dominance.
Right, exactly. This tech battle overseas, it's not happening in a vacuum. It directly impacts your portfolio, the broader tech industry, and honestly, ultimately, the prices of everyday products that you buy.
Yeah, because the global tech ecosystem it's entirely interconnected. I mean, whatever happens in a major market overseas, it eventually washes up on American shores.
For sure. So what is actually going on over there?
Well, based on recent analysis, there's this really pervasive misconception about what is driving the Chinese AI sector right now.
Like, people just think it's chaos.
Yeah, pretty much. Casual observers, they look at the sheer volume of activity and they just assume it's this money-losing, chaotic free-for-all.
Right, just burning cash.
Exactly. They see companies burning through billions with, seemingly no real end game. But if you look deeper at the mechanics of this market, the strategy is actually highly calculated.
Okay, so it's not just blind spending.
No, not at all. We are watching a really deliberate effort to turn artificial intelligence from an incredibly expensive premium luxury into just a cheap, everyday commodity.
Wow.
And the ultimate winners in that economic shift, they might not actually be the tech giants building the software.
Okay, well, we're definitely going to get into who the winners are, but let's start with the sheer scale of this first, because honestly, the numbers are kind of hard to wrap your head around.
They really are.
So looking at the data, as of June 30, 2026, there are 988 registered generative AI services in China.
Nearly 1,000.
Yeah, nearly 1,000. And just for anyone new to that term, a generative AI service is basically any software that can generate new text, images, or code on its own. So, like a chatbot or an automated design tool.
Right.
And nearly 1,000 of these are officially registered. The market is just exploding.
It's a massive surge. I mean, according to the data, just in the first 6 months of the year, that number jumped from 748 to 908.
That is huge growth for just 6 months.
Yeah, but, to be totally clear on the technical side, not all 988 of those are massive independent brains built entirely from scratch.
Yeah.
Many are smaller applications that are sort of piggybacking on a handful of foundational models.
Right, like apps on a smartphone.
Exactly. But the economic takeaway remains the exact same.
Right.
The sheer supply of AI tools is skyrocketing. And the contrast with the U.S. is what makes this really fascinating.
Because the U.S. strategy is totally different.
Completely different. In the U.S., the prevailing business narrative is this race to build the absolute smartest, most capable, almost godlike AI.
Right, the super genius model.
Yeah, it's a race to the top of the performance mountain. And American companies, they're more than willing to charge a massive premium for that top-tier intelligence.
But the overseas strategy it's basically the opposite.
Right. They are fighting a brutal price war to offer, good enough AI for absolute pennies.
14 cents to be specific.
Yes.
Because looking at the latest data, there's this company called DeepSeek, and they released a model named V4 Flash. And the cost to use it is just 14 cents per 1 million input tokens.
Which is incredibly cheap.
It is. But for our beginner listeners, we should probably clarify what a token actually is, because the industry throws that word around constantly.
Yeah, it can be confusing. So think of a token as a small chunk of a word. When you type a prompt into an AI, it doesn't read words the way you or I do. It breaks them down into these little syllables or chunks.
Okay, so it's breaking down the text.
Right. And 1 million input tokens is roughly equivalent to about 750,000 words.
Okay, so just to put that in perspective for everyone listening, you could feed this AI the entire text of the complete works of William Shakespeare, ask it to summarize the major themes, and the computing costs to process all of that text would be about 14 cents.
Exactly, yes. And that fundamentally changes how businesses deploy the technology.
Because it's so cheap.
Right. I mean, if a logistics company needs to sort through millions of messy shipping addresses, or say a retail brand wants to automate their basic customer service emails, they don't need the world's most advanced, expensive AI model for that.
No, they don't need the super expensive genius CEO model.
Exactly. They don't need the CEO model that charges premium rates.
Mm-hmm.
The 14-cent model is perfectly adequate for that job.
Right.
So by driving the price of basic cognitive tasks down to the floor, these companies are forcing massive, widespread adoption across all these traditional industries.
But wait, if they are dropping their prices to practically zero, 14 cents is basically zero for a big business. I just struggle to see how the math works for the companies building this tech.
It's a fair question.
Because the common narrative here in the States is that the Chinese government is just, bankrolling the entire operation, like throwing limitless subsidies at these big tech companies so they can afford to just flood the zone and give it all away for free.
Yeah, that is a very common assumption. But recent analysis actually shows it's really only half true.
Oh, really?
Yeah. I mean, the central government is certainly pushing for broad AI adoption. They have this nationwide AI plus policy.
What?
It's aimed at integrating artificial intelligence directly into traditional manufacturing, retail, logistics, that sort of thing. And local municipalities are even handing out these computing vouchers.
Like coupons?
Essentially, yeah.
Yeah.
Coupons to help smaller traditional businesses afford the hardware power they need to run these new AI tools.
Okay, so the government is involved.
They are, but, and this is the key part, the central government is not just handing blank checks to tech giants like Alibaba or Tencent to subsidize their software.
So the massive price cuts, it's not just some government-funded charity program.
Far from it. The rock-bottom prices are the result of a vicious private market fight for survival and market share.
Oh, wow.
It is a textbook price war. These companies are voluntarily bleeding potential revenue to capture as many users as possible today, with the goal of making their specific AI ecosystem the default industry standard tomorrow.
Okay, that makes total sense. It's like the classic software free trial model, but on steroids.
Yes, exactly.
You give the product away for basically free to get everyone hooked. A traditional manufacturing plant, integrates your 14-cent AI to run its entire supply chain.
Right.
And now that the factory completely relies on your software just to keep the lights on, you finally flip the switch and start charging them real money.
And based on the latest market movements as of August 2026, we are witnessing the exact moment that switch is being flipped.
So stage 2 is starting.
Yes, the free sample phase is definitely drawing to a close, and the industry is entering the monetization stage.
Okay.
These tech giants are really testing the waters to figure out how to extract actual profit from the massive user bases they've cultivated.
But what is the actual mechanism for that? How do you suddenly start charging for something that users have just come to expect to be nearly free?
Well, one method is changing the licensing rules. So take Alibaba's family of models, which is known as Qwen.
Okay.
Historically, these have been what the industry calls open source.
Right, which means it's free to use.
Yeah, in simple terms, open source means the creator publishes the underlying code, kind of like giving away the secret recipe so any independent developer can just download it, tinker with it, and use it for free.
But they're changing that.
Right. Recent reports indicate Alibaba is considering a new licensing structure. They're looking to charge large commercial users a percentage of their revenue.
Oh, wow. So if you get too successful.
Exactly. The underlying message is, if you take our free recipe and use it to build a multi-million-dollar business, we are taking a cut of your profits.
That's a huge shift. And what about that DeepSeek V4 Flash model, the one processing Shakespeare for 14 cents? Are they raising prices too?
So DeepSeek is taking more of a tiered approach.
Yeah.
They recently launched a pro version of the V4 model.
Okay.
And while the basic Flash version is still dirt cheap, the pro version is priced up to 14 times higher.
Oh, wow. 14 times.
Yeah. So they establish a baseline of cheap, good enough performance, right? And then they charge a massive premium the moment a business realizes they need a slightly higher level of reliability or, more complex reasoning.
Right. So the era of limitless free supply is shifting.
Very much so. It's shifting into a quest for a sustainable business model.
Well, if they are finally introducing paid tiers and demanding revenue cuts from businesses, you would assume their balance sheets are starting to look pretty healthy, right?
You would think so.
But looking at the recent earnings reports, Alibaba's financials tell a totally different and honestly kind of alarming story.
Yeah, when you look at Alibaba's Q2 2026 numbers, The sheer financial pain required to build this AI infrastructure just becomes glaringly obvious.
What do the numbers say?
Their overall net income plummeted by 75% compared to the previous year.
75%.
Yes. And even more striking, they burned through roughly $6.58 billion in free cash flow in a single quarter.
Okay, net income dropping by 75% and burning over $6 billion in cash. I mean, for a casual observer, that sounds like a company in a complete death spiral.
On paper, it looks terrifying. I completely agree. But to understand the underlying health of the business, we have to separate their daily operations from their massive investments in the future.
Okay, how do we do that?
We need to look at a concept called capital expenditure, or CapEx.
CapEx.
So CapEx is simply the money a business spends to acquire, upgrade, or maintain physical assets.
Physical things.
Right. In the tech world, that means buying land, building massive data centers, installing these huge industrial cooling systems, and of course, purchasing tens of thousands of specialized microchips.
The hardware.
Exactly. And in the exact same quarter where Alibaba burned through that $6 billion in cash, they actually spent $10 billion specifically on CapEx.
Oh, wow.
And they have publicly committed to spending an astonishing $56 billion by 2029 just to build out their AI and cloud physical infrastructure.
So it's not that their actual software products are failing to sell. It's kind of like having a wildly successful burger joint.
Okay, yeah.
Like you are selling thousands of burgers every day, there's a line around the block, and you are making a solid profit on every single meal, right?
Right.
That core business is thriving. But you are so incredibly ambitious that you take all your daily burger profits, plus, billions of dollars in massive bank loans, to instantly start construction on 500 new restaurant locations across the country all at once.
That's a great way to put it.
So your daily business is doing great, but your overall bank account is draining at a terrifying speed because the construction costs, the CapEx, are just astronomical.
That captures the dynamic perfectly.
Mm-hmm.
The financial pain isn't coming from the product itself. It's coming from the cost of building all those kitchens, so to speak.
Right.
And to be clear, Alibaba's AI burgers, going with your analogy, are selling incredibly well.
Really?
Yeah, their actual cloud and AI division saw revenue grow by 45% in that quarter.
Wow, 45%.
And their operating margins, which is the profit they make on the day-to-day services, actually improved. So the AI business itself is highly lucrative and it's growing rapidly.
It's just the construction costs.
Right. The physical data centers required to run those services are so mind-bogglingly expensive that it masks the underlying success of the software.
Which, that brings up a very harsh reality for the rest of the market. Because according to recent industry projections, the cost to train just one single leading-edge AI model could surpass $1 billion by 2027.
Just for one model.
Right. If it costs $1 billion just to build the digital brain, and then billions more in physical data centers to actually run it, how can any of those 988 registered AI services possibly survive?
They can't.
The math just doesn't work for a small company.
It doesn't work at all, and that is the brutal truth of this specific tech cycle. Independent AI startups, companies whose only product is an AI model, they are facing an absolute existential crisis.
Because they just don't have the cash.
Right. They simply do not have the financial runway to burn billions of dollars on physical infrastructure, while, at the same time, simultaneously fighting a race-to-the-bottom price war where they are charging pennies for their product.
So the independent guys just run out of venture capital cash and disappear.
Yes.
And the only players left standing are the massive monopolies.
Exactly. The only companies that can survive this are the diversified giants who have massive, totally unrelated cash cows to fund their AI ambitions.
Like Alibaba's e-commerce.
Right. Alibaba has this enormous global e-commerce empire. Tencent has incredibly lucrative gaming and social media platforms.
So they use that money.
Yeah, these giants can just take the billions in profit they make from selling shoes online or, microtransactions and mobile games, and they funnel that cash directly into buying AI servers.
Right. And the smaller startups, they don't have a shoe business to fall back on.
Exactly. They have nothing to prop them up.
Well, if you're Alibaba and you are bleeding $10 billion a quarter on physical infrastructure, you must be desperate to find a way to make those data centers cheaper.
Desperate is the right word.
And looking at the broader tech landscape, the biggest expense in a data center is the specialized microchips, right? Which are predominantly made by U.S. companies like NVIDIA.
Which brings a massive geopolitical angle into play here. Relying on foreign hardware is not only wildly expensive, but under the current U.S. administration's trade policies, it is incredibly risky.
Oh, definitely. Tariffs, export bans.
Exactly. That is why Alibaba is aggressively pushing to design and deploy its own in-house microchips to power its data centers.
But how does building their own chips actually lower the cost? I mean, are they just avoiding the markup?
Well, avoiding the markup is a huge part of it. I mean, NVIDIA enjoys massive profit margins on its top-tier chips. So by bringing the design in-house, Alibaba cuts out the middleman entirely.
Makes sense.
But more importantly, it allows them to tailor the physical silicon to do one specific job incredibly efficiently.
What do you mean?
So in the AI world, there are two main phases. There's training and there's inference.
Okay.
Training is when the AI is essentially sitting in a lab going to school, right? It's analyzing billions of documents to learn how to think. That requires incredibly powerful, very versatile chips.
That's the billion-dollar part.
Right. But inference is when the AI actually goes out into the real world to do its daily job, like answering a customer's email or routing a delivery truck.
So inference is just the day-to-day application of the intelligence it already learned.
Yes. And Alibaba is designing chips specifically optimized for that day-to-day inference.
Ah.
By custom building chips that excel at running those specific 14-cent tasks with very low power consumption, they drastically lower their ongoing operating costs.
Wow.
If they achieve that hardware independence, they can make their rock-bottom software prices sustainable in the long term, regardless of whatever U.S. export controls are in place.
I mean, that feels like a direct threat to the American tech sector.
It absolutely is.
If overseas companies are successfully driving the cost of AI down to absolute pennies, and they are building their own hardware to make those cheap prices permanent, it creates this massive deflationary wave.
Yes, global deflation in tech.
Because if you are an American business, why would you pay a sky-high premium for a U.S.-built AI model when an overseas competitor is offering a model that is, 90% as smart for a fraction of a cent?
You wouldn't. I mean,
Yeah.
You just wouldn't. And that is the deflationary pressure spreading globally. U.S. tech companies are going to really struggle to maintain their massive profit margins on foundational AI models if the global baseline cost of machine thinking is approaching zero.
That's a huge shift.
The economic value is shifting entirely. The companies making the AI models are turning their own products into cheap, interchangeable commodities.
Okay, let me pause and challenge the logic here for a second.
Sure.
If the AI makers are intentionally dropping their prices to pennies, dragging the global market down with them, and simultaneously bleeding billions of dollars in capex to build the servers, aren't they just cannibalizing their own industry?
It certainly looks that way.
Because if the creators of the tech are destroying their own profit margins, where's the actual wealth being generated in this new economy?
That is the most important economic takeaway of this entire analysis. The biggest financial winners in the AI boom are likely not going to be the companies making the AI.
Really?
The ultimate winners are the companies using the AI.
Wow. That flips the entire investment narrative totally on its head. I mean, most people assume the wealth goes to the creator of the technology.
Historically, that just isn't always true when a technology becomes a universal utility.
Give me an example.
Let's look at real-world examples from the current data. Take a company called ACE Robotics. They aren't building foundational large language models. They aren't doing the billion-dollar training. Instead, they take these incredibly cheap, off-the-shelf AI brains and they integrate them into the physical control systems of warehouse robots.
Oh, I see.
Suddenly, a traditional mechanical sorting robot has enough cognitive reasoning to adapt to messy environments, recognize damaged packages, and basically optimize its own route across a factory floor.
And because the underlying brain power only costs pennies, ACE Robotics can deploy these highly intelligent machines at a fraction of the cost it would have taken even 2 years ago.
Exactly. Traditional sectors, logistics, manufacturing, e-commerce supply chains, they can now afford to embed high-level cognitive automation into every aspect of their operations.
And it costs them practically nothing.
Right. They're drastically slashing their labor costs and optimizing their logistics for basically nothing. Their profit margins are exploding because their operating costs are plummeting, and it's all thanks to the AI companies fighting a price war.
That makes total sense.
A powerful historical parallel for this is the global electric vehicle and solar panel boom from the last decade.
Oh, right. The solar panel industry is a perfect mirror for this, because a decade ago, everyone assumed the companies manufacturing the physical solar panels were going to become the most valuable corporations on Earth.
Right.
Because solar was the energy of the future.
Right. But the reality was an absolute bloodbath for the manufacturers.
Right.
Massive government incentives led to immense oversupply. Fierce competition drove the price of physical solar panels into the dirt. It was a race to the bottom that destroyed the profit margins of the panel maker.
Because everyone was undercutting each other.
Exactly. Dozens of manufacturers went completely bankrupt, and the survivors barely scraped by. But who actually benefited from that price collapse?
The consumers and the businesses buying the panels.
Yes.
I mean, if you were a traditional factory owner, you were suddenly able to buy dirt cheap solar panels, blanket your warehouse roof with them, and power your operations with practically free electricity for decades. The manufacturers basically bled cash to provide you with a cheap utility.
Exactly. The wealth wasn't captured by the people producing the power source. It was captured by the people applying that cheap power to build real-world products.
Wow.
The exact same trajectory happened with early electric vehicle battery manufacturing, and it is happening right now with artificial intelligence. AI is rapidly transitioning from a novelty product into a basic underlying utility.
Yeah.
You should think of cognitive reasoning the exact same way you think of electricity or tap water.
So for you, the listener, whether you are managing a stock portfolio or running a small business, the takeaway is pretty profound. You don't necessarily want to invest your capital into the company spending billions to lay the water pipes, because they are trapped in this vicious fight for pennies against massive monopolies.
Exactly.
You want to invest in the factory that is tapping into that cheap, abundant water supply to manufacture a tangible product at a massive profit.
The deflationary pressure of these cheap overseas models might be a massive headache for the American tech giants trying to protect their software margins, but it is a total windfall for the broader global economy.
Right.
The cheaper the digital brain power gets, the more lucrative the real-world applications become.
That's incredibly insightful. Let's bring this all together. We started by looking at a Chinese AI ecosystem that, on the surface, looked like this chaotic bubble with nearly 1,000 services flooding the market.
Right.
We dug past the myth that this is entirely propped up by government handouts and revealed a brutal private market price war where companies are offering AI for 14 cents just to capture market dominance.
We then saw how that relentless price war is forcing the industry into a massive, capital-intensive battle of attrition. Giants like Alibaba are burning billions in free cash flow to build out custom hardware and massive data centers, desperately pivoting toward monetization just to survive the infrastructure costs.
But the crucial insight here is that by turning AI into a cheap, everyday utility, these tech giants are inadvertently transferring the real economic value away from themselves and into the hands of traditional businesses.
Yes.
The companies that figure out how to leverage this ultra-cheap digital intelligence to lower their operational costs are positioned to be the true winners of this era.
It forces a complete reassessment of where value lies in the future economy. And, it leaves us with a rather profound long-term question to consider.
Which is?
If artificial intelligence truly becomes as cheap and accessible as electricity across the entire globe, available to anyone for pennies a minute, what happens to the premium we place on human cognitive skills?
Man, that is a dark path to go down. What exactly does that mean for the average knowledge worker?
Well, think about the last 50 years of the global economy. We have placed a massive financial premium on the ability to write complex software code, analyze sprawling data sets, or, draft intricate legal documents.
Right.
Those cognitive skills were the ultimate path to a high income. But if an AI model can execute all of those tasks instantly for 14 cents, do those human skills fundamentally lose their market value?
Wow.
Are we rapidly entering an era where the sheer ability to think or process data is no longer scarce, leaving the ultimate economic rewards exclusively to those who possess tangible physical resources? Will the future belong only to those who control the raw land, the physical energy grids, and the actual copper wires required to keep the machines running?
If thinking becomes cheap, physical reality becomes the only thing that's expensive. That is a staggering shift in how we value human labor, and it is definitely something for all of you to mull over as this market continues to evolve. Thank you so much for joining us on this deep dive. Don't forget to subscribe and hit that like button.